In April 2026, the Strait of Hormuz became a theater of the absurd. Despite conflicting claims of its reopening, U.S. naval blockades and Iranian threats have effectively choked a primary artery of global energy. Over 300 tankers are trapped in the high seas, while spot Brent crude has surged to $138 a barrel. The IMF warns that this disruption has halted the momentum of global growth, citing rising deficits and energy inflation as critical risks. Yet, looking at the major stock indices, you would see a different world entirely. Financial markets are largely shrugging off these physical catastrophes, choosing to ignore the fire on the news feeds. This chart shows the S&P 500 hitting a new high of 7,147 at the exact same time global oil prices were spiking. European markets and India's Nifty 50 followed suit, detaching entirely from the supply chain reality. The absurdity was laid bare when a single tweet claiming the strait was open caused markets to surge, even as actual tankers on the water were executing U-turns because the blockade was still very much in effect. We have to ask why the global financial apparatus is aggressively rewarding this chaos. To understand how the market can stay this bullish in a burning world, we have to look at the mechanics of the disconnect. The disconnect begins with the record-breaking volume of cash currently sitting in the global financial system. It is a legacy of trillions of dollars injected by central banks since the 2008 crisis and the pandemic. This liquidity is constantly looking for returns. It is sustained by monthly retail flows, like the 25,000 crore rupees moving into Indian indices, and a professional class of whales who are convinced that geopolitical threats are mostly theatrical. Markets are often described as discounting machines. They don't trade on today's headlines. They trade on where they expect the world to be in 6 to 12 months. For most investors, war and tariffs are treated as temporary weather events. They are betting that these disruptions will clear, leaving the underlying value of their technology and infrastructure investments intact. This overwhelming force of liquidity essentially forces the market to look past the smoke and fire of the present, betting everything on a theoretical, idealized future. The market believes that future will be defined by artificial intelligence. Investors are shrugging off geopolitical risk because they believe AI-led productivity will create permanent long-term value that outweighs temporary trade wars. However, this singular focus has created a massive concentration risk, distorting the very definition of a healthy stock market. This visualization shows the S&P 500. Just 7 tech stocks account for $19 trillion, 30% of the index, leaving 493 stocks in their shadow. The danger? The broader economy isn't thriving. Dragged upward by a single sector, any AI hitch collapses the edifice. The market's survival is no longer tied to global stability or manufacturing. It is now hostage to the unchecked, permanent growth of a few AI giants. There are real-world consequences to this transition that Wall Street is currently refusing to price into its models. Consequences that start with the people who actually power the economy. AI-led trimmings are already appearing at companies like Amazon, and IT services, the largest formal exporters and employers in nations like India, now face an existential threat to their traditional business models. Services deliver over half the growth in large economies, and those services rely on human employment. If displacement occurs at scale, it reduces the pool of wages that fuel middle-class consumption, the primary driver that actually sustains corporate growth over the long term. Beyond the threat to labor, there is a second, more immediate pressure building in the background: the global debt load. Former U.S. Treasury Secretary Henry Paulson has warned that American federal debt is reaching a breaking point, currently at $39 trillion. This level of debt threatens to destabilize the bond market. If interest rates remain high to combat the energy inflation we're seeing, the cost of servicing this debt could spark a massive financial emergency. Sovereign debt issuance in OECD countries is projected to reach $18 trillion this year. Crucially, 40% of the sovereign and corporate debt held in these nations is scheduled to mature by 2027. For now, the markets are happy to ignore the blockades and the debt bombs in favor of AI-led optimism. But eventually, the collision between maturing debt and falling consumption will force a harsh return to physical reality.